This is Michael Fox, and this is the Prospector News Podcast. And joining me here post PDAC, I have Chris Temple from the National Investor. Welcome aboard, Chris.
Hey, Mike, I'm sorry I missed all of the fun and the snowstorm up there, but I had heard some great reports, including from you, so I'm sure it was worthwhile.
You know what? It was a very worthwhile trip to Toronto. The snowstorm, it was very short, but what freaked a lot of people out, they have a phenomena that happens with lake effect snow, as you probably are aware. It's called thunder snow, where you've had an actual thunderstorm during a snowfall. And for people that didn't know that was possible, they were quite shaken and wondering if the apocalypse was descending upon Toronto in time for the PDAC.
Well,
but the only apocalypse was the travel that it messed up.
No, I've been in thunder snow more than once in years past, including on a frozen lake and including riding my snow machine down the road, wondering if I'm going to get struck by lightning as well as by all the snowflakes. So I've seen it. It's unique.
Yeah, it definitely is. And now a few more people know exactly what thunder snow is. But I tell you, Chris, you know what isn't, scary is that I was in the PDAC bubble for the most of this week, and I emerged today and I found absolute market mayhem out there that happened while I wasn't paying any attention. So I guess it started early in the week with Powell's testimony. He threw another turd in the punch bowl.
Well, it did. I put out a missive on Monday evening for people that are on my mailing list, and I said, "Here's what Jerome Powell is facing." Okay, you've got, and the headline, in fact, Mike said, "The Mexican, or I should say Asian standoff over monetary policy." The Bank of Japan single-handedly has printed more money in recent months than the Fed has rolled off of its balance sheet. It continues to flood the world with liquidity, starting in Japan, but also elsewhere, which, among other things, we're not going to get into this subject today, is part of the explanation of why we have an inverted yield curve. It's not all a recession indicator, though it is to some extent. It's because so much money has been printed in Japan and then recently again in China that it has more than negated what the U.S., the Bank of Canada, the ECB, the Bank of England have done to try and sop up at least a little of this ridiculous liquidity that we had flooding the world the last few years. So that was the challenge the Fed had coming into this week when Jerome Powell was slated to go in front of Congress, which he does twice a year. Us old timers like me still call it his Humphrey Hawkins testimony after the two legislators who wrote this back in the 70s. But it's basically the Fed's job, according to Congress, to come in front of Congress twice a year, the House one day, the Senate Banking Committee the next, to explain himself. What is he doing? How is what he's doing with monetary policy good or bad? And unfortunately, and this only gets worse over time, the questions that come from most of these senators and congressmen, both Republican and Democrat, reveal, among other things, just what idiots most of these people are that have utterly no idea what they're talking about. They'll give a speech that's supposed to be a question about something that they want to spout off on, and none of them have the slightest idea what makes the world go around. But all that said, Powell jerked market expectations pretty dramatically in a direction on Tuesday and Wednesday of the idea that not only is the Fed not done fighting inflation and tightening policy, but it's quite conceivable that they go back to a faster pace of rate hikes. In other words, that going back to 25 basis point rate hike this last time could have been a mistake, and that they've got to go the other direction. So at least through midweek and even through part of yesterday, Thursday, that was how the markets had come to price themselves. So among other things, we had the 2-year Treasury note went above 5% for the first time since 2007. That, of course, was when interest rates were creeping up ahead of the financial crisis the next year. We saw gold get hit. We saw other commodities get hit. Copper briefly with a 3 handle again, dipping back below $4 a pound. The stock market getting whacked to the point where, as of yesterday's close, we had negated the entirety of the allegedly bullish breakout for stocks back above their downtrend line, meaning that when we're not closed yet, we're doing this before 1 o'clock Eastern on Friday, depending on where we close today, we might have fully negated that, or maybe not. We'll see, because we've had other things that have added to the volatility just since late yesterday.
Yeah, well, the one thing that I grabbed a hold of when I saw the headline from Powell, again, that was this morning. Playing catch up on the news of the week, being in the dungeon. If people know about the PDAC, it's in the basement of the convention center, about 3 floors underground. So I refer to it as the dungeon. It's we were going to end up with a higher interest rate than what the original target was going to be set. Hearing him say that they were going to possibly go back to 50 basis point increases, that didn't surprise me, because as you recall, I had thought them dropping to 25 was a mistake at the time, because they hadn't really solved some of the inflationary problems.
No, they haven't. And in fact, a lot of things, as you and I talked the last time that we did this, there's certain parts of the equation going back in the opposite direction. Among other things, we've seen the best news we're going to from lower energy prices than we had for most of last year. And they're slated to go back the other direction. So, yeah, I mean, this was before the events that are unfolding more dramatically today as we're talking. This was already a tall order for Powell to try and bring market expectations back to a tighter Fed policy, and one where he still has to push back against the what the Bank of Japan and the People's Bank of China are doing. This is again part of the explanation why you've had going on 500 basis points shortly of rate hikes in 12 months. And yet the stock market is down relatively little compared to what you would have expected, given that magnitude of rate hikes. And there's not really been anything major as far as the economy is concerned. We're still plodding along, some parts of the economy doing better than others, but, we're not even technically in a recession yet. Now that's coming in one form or another, but yeah, it's so that's where we were anyway at midweek with the Fed convincing the markets at least somewhat, and the markets responded a bit. Interest rates in the market ticked back up considerably, as I alluded to. The 10-year Treasury crept back up above 4% finally. Seemed like it was going to keep going. Gold got hammered. It was heading back to 1,800, and the stock market got hammered, et cetera. So far, so good until he just had another monkey wrench thrown into his plans in the last 24 hours, really less than 24 hours.
Yeah. Before we go down that particular road, though, I did have another question and a ponderance. The Bank of Canada came out with their rate announcement this week, and they held firm with no further increases in the basis rate in Canada. I understand the Bank of England is looking at a pause as well. And if Powell is in fact going to go and can be aggressive and go to 50 points, is that not going to start to rally the US dollar upwards again? And is that going to put headwinds back into to commodity prices?
Well, it certainly could. We saw some of that, in fact, for the first half or so of this week, even through part of yesterday, Thursday, where we saw, as I alluded to, gold had dropped off. Silver broke $20 briefly. We saw the stock market get hit. We saw oil prices come back down a little bit after they've tried to get back up off the mat in recent days, et cetera. So, yeah, I mean, if we were going to go back to a place where the Fed was disproportionately hawkish compared to everybody else, that would risk upward pressure on a dollar with all of the negative things that brings with it. So we did see some of that. And look, if this episode right now that's unfolding before our eyes today proves to be relatively minor, and the Fed can still at least keep going with 25 basis point hikes. We still could see that upward pressure on a dollar, because don't forget that until something really does force the Fed to stop, they're on the quest to make sure that they I mean, he won't admit this in so many words, and it was comical to see the way in which some of the senators and Congress critters this week were trying to force him to admit this. But yes, he knows he's going to throw a few million people out of work and push the unemployment rate higher meaningfully. He knows he's going to put a major dent in what wage gains there have been for the American workers in the last few years. He knows that he is going to engineer a recession. And he knows all of those things, because that's all what comes when your professed goal, and he has said this at least over and over again, that to fight inflation, he must reduce demand. And you reduce demand by making sure that there's less people working, that those working have less to spend, and last but not least, that you put a major dent in the wealth effect. So when people see their stock portfolios going down anew, when they see their real estate equity going down a fair bit after the huge gains of the last few years, all of those things are things that, you know, he won't always admit in so many words that he wants them and that they're coming, but if he has his way, they are.
No, definitely. Well, we've been alluding to the elephant in the room today, so let's go let's go down to it. We have Silicon Valley Bank in looks like in severe distress. They've been had a stop trade put on it. They were down, I believe, 60% yesterday. They're way down. I was looking at their last 52 weeks, and at one point they were at a high of nearly $600, and when the stop was put on, they were at $106. There's been talks that there's going to be a run on this bank. Who is Silicon Valley Bank? Let's start with that. And what the hell?
Well, look, a lot of people from day one, myself included, as you know, have said that, look, the Fed is serious politically and otherwise. They must try and put this inflation back in the tube that they were the proximate cause of the last few years. They were late to the game. Everybody knows that now. But that at some point the Fed was going to break something. And this is the first major thing that has come out in the news during this rate hiking cycle that suggests that, yes, the Fed finally did break something. Didn't happen all today or yesterday, but this has been looming, and it was the inevitable consequence of getting everybody, including not the least of which are financial institutions themselves, hooked on the sugar high of ZIRP policy, zero interest rates, borrow scads of money for next to nothing or essentially nothing, loan it out and hypothecate it and leverage it and everything else that we do today with modern money mechanics, and you're going to live happily ever after. That works great until things go the opposite direction in the market. So let me give you as quickly as I can the Cliff Notes version of the story. Silicon Valley Bank is a uniquely Californian institution. The disproportionate amount of their business, both in retail depositors and in their investment banking and similar businesses, has to do with Silicon Valley. It has to do with technology, biotech, startups, and so forth. A very dynamic institution, which a lot of people are really enamored with that live in California, because they have seen this bank as the poster child for American ingenuity, and of course, to be true, also for American hubris and excess when it comes to credit. All right. So again, for as long as the Fed is keeping interest rates down to nothing until the last year or so, all is good. You've got people that are depositors in this thing whose money is going to work in all manner of startups and so forth. But here's what happened. Problem number one, and I'm giving folks the Cliff Notes of the Cliff Notes version of this story. Don't get upset if I leave something out. We don't have hours on here today. And this is an evolving story as well. But problem number one is a lot of money was raised by would-be startups, by companies that were already going. It was deposited in this bank, and a lot of these companies hit a brick wall in the last couple of years or so, when all of a sudden the markets turned against them. First, because of COVID, the fears about that. Then with interest rates going up and that hitting the overall stock market, as people who are investors know, the volume of IPOs and M&A activity and stuff like that among these kind of companies shriveled to next to nothing compared to what it had been not that long ago. So what happens is Silicon Valley Bank, its holding company, decides that rather than just keep all this money on deposit, they're going to go out and do what at the time seemed like the prudent thing, and invest it in all manner of fixed income investments and bonds and things like that to make a little bit of a profit, since these people didn't all need their money all at one time. But like a lot of people on Wall Street in the last year now, they didn't take seriously at all the Fed's promise all along the way, which has been consistent, that yes, we're going to raise interest rates, we're going to raise them higher, and we're going to keep them there longer than a lot of you want to admit. So maybe you better start listening to us. Now, the consequence of that is that as the Fed raises interest rates, the value of the bonds with far lower coupons that Silicon Valley Bank bought, they're underwater. Because if you bought a bond, let's say 2 years ago, with the yield of 75 basis points and you paid par or full value for it now, that bond is no longer worth its full value when bonds in the market being sold today are being sold maybe at 5%. So everything is fine even with that, since the Fed in the recent years, thanks to 2008 and other episodes, they suspend what are called mark-to-market rules. You can be underwater with your bond portfolio, but unless you actually sell something, you don't need to report it. Well, for some reason, which a couple commentators were at pains to try and understand even this morning, Silicon Valley Bank decided to sell a bunch of their holdings because apparently they were in some kind of liquidity distress already. That locked in and made a present fact of major losses on these things. At the same time, they're trying to raise money from investors, and investors see this happening and say, what, are you nuts? And they balk at it. Depositors are pulling their money out as fast as they can, and all that leads to, you mentioned the stock price. This was a $600 or $700 stock not that long ago, closed at 106 yesterday. It was halted, didn't open today. Had it opened early on, it was going to open at less than 40. So you've got tens of billions of losses in equity, multiple billions of losses in the bank's own equity, its net deposits and so forth. As we're recording this, and again, this is an evolving situation, Mike, but the regulators have shut the bank down. The FDIC has just said that covered deposits will be available as early as Monday. That's allowed for a little bit of relief in the markets today, but not before you had the most dramatic and fast reversals of moves that I have seen ever outside of the context of 2008. We were pushing 5.1% on the 2-year Treasury a day and a half ago, even maybe yesterday morning. At one point this morning, they had dropped by half a point. Japanese government bond yields dropped the equivalent of almost 20%. It's mind-numbing how fast, as this news unfolded, everybody came out and were betting that the Fed finally did break something, and now whatever Powell said just 2 short days ago, they're going to be forced to stop raising interest rates. So the dollar was down more than a full point. Gold regained what it lost earlier this week on the more hawkish news, et cetera. So this is still an evolving thing, but everybody knows and can see with other bank stocks getting hit to varying degrees that the troubles that have now been realized by Silicon Valley Bank are on everybody's balance sheet that owns government paper. The question is what forces more of these dominoes to fall, and that's going to be something that we're going to, for today, leave an open question. But this is the beginning of this type of thing, I believe.
Well, I'm sorry to hear we're going to leave that as an open question, because I could see there's being contagion here. And the question that comes to my mind is, where is that contagion going to take hold? Is it going to be in other banks, or is it going to be in the tech sector?
Well, look, it's already adding to the woes in technology stocks. And again, a lot of this is what happens when you remove moral hazard, when you have what we had for a long time that some call the Fed put. My wife and I were discussing this morning, as we were watching the news, and I'm rewinding the TV because I want to make sure I understood this point that someone was making, et cetera. So I'm trying to, have this discussion, explain it to her. But when you have a culture and an environment, which again, this is the Fed's creation, this didn't come from anybody but them, where you no longer have consequences if you make a bad investment decision. If you're a financial institution, you can do any stupid thing under the sun imaginable, and if your bets go sour, the Fed's going to cover them. Okay, that gave us 2008. It led to this kind of issue today because, again, the Fed printed all these zillions of dollars, especially in the last few years, kept interest rates down to nothing. Silicon Valley Bank and everybody else, to one extent or another, did all the same stuff. You have depositors' money you can leverage, you borrow money you can leverage, and you buy all of this stuff that the Fed is pretty much guaranteed you can't lose. But now all of a sudden the Fed shifts policy and these things now do lose money. And it's going to interest me greatly because, look, the FDIC can cover insured depositors to a certain extent. But anyone who's ever known what happened in 2008 knows that the proper moniker for the FDIC really means the fraudulent and deceptive instillers of confidence, is an old mentor of mine in financial matters used to quip many, many years ago. They do not have enough money on hand to cover everybody. If things get completely out of hand, that all this debt needs to be monetized if the Fed and Treasury think they have to do that. So we'll see what happens. There are going to be some investors that lose. A lot of them already have. It's going to certainly, when your question on the tech sector specifically, it's certainly thrown a major bucket of ice water on financing activities and IPO plans generally. So that's going to go from bad to worse. It's going to be a taller order for a startup now to raise money and to get any investors that want anything to do with it. So again, this is breaking. I mean, this is literally since the end of the trading day yesterday that this all really started to crystallize in front of people. It's going to be evolving for days and weeks ahead. We'll see what the contagion is days or weeks ahead. But you remember probably Warren Buffett's favorite saying, and I'll paraphrase it a little bit. I don't have the exact quote in front of me, but after periods of excess liquidity and too much easy money, when things go back to normal and the tide goes out, who's been swimming naked.
True that. Now,
And
is this Lehman Brothers 2.0?
well, financially, there's no question that it is. The question more so, Mike, is going to be what are the regulatory and Fed responses going to be to this? A lot of people go back to 2008 and they say that if the Fed and the Treasury had acted sooner and were not of a mind to let nature take its course, maybe that crash and the resulting recession would have been less bad. There's arguments on both sides of that. But we'll see what happens now. I have to believe that, and I have seen this also bandied about today in the Twitter sphere and in the financial press and otherwise, that assuming that's all we can do for right now, assuming that there is no significant contagion, that the FDIC shores up retail depositors so that you don't have Joe Six-Pack Sally Soccer Mom insurrection, and that the losses for the tech companies and major investors can be contained within the proverbial four walls of what SVB was all about, then maybe nothing significant changes. I mean, after all, when you go back, you don't have to go back, but I think it's been a year and a half saga now, maybe a little bit longer, of Evergrande in China, a few $100 billion worth there as well of investments and quote assets unquote, all start to implode. China pulls off an engineered, or I'm sorry, they pull off what they call a marketized default. So they force, in some cases, big investors to take a haircut. They force, in some cases, big investors to actually take title to fractional pieces of real estate because nothing is liquid. And that's how they deal with the problem. And to the surprise of a lot of people, yours truly included, they to date have pulled that off. So I would suspect that if they think they can get away with it without having a lot of contagion, that the Fed does want, in this case, there to be consequences for people who made these kind of decisions. And that they do not want to come in at this first sign of trouble and bail out this institution. It's not going well so far right now. There were a couple of attempts literally in recent hours as this whole thing was unfolding to have kind of a similar situation to what happened. I think it was with Bear Stearns, where you get a handful of people come in and buy the assets for a few pennies on a dollar and quote, you've quote saved the system. You sure as hell didn't save Bear Stearns and a lot of the investors, but you saved the system. The early attempts to get some of the bigger financial institutions to step up on this has been a goose egg so far. So we'll see what happens, but it's the point for present purposes, and God only knows what Monday's going to bring, is that there's never been, and I think even if you go back to 2008, there's never been the abrupt change one direction and then back to the opposite direction in a matter of, I mean, we're talking 48 hours, really, in what Fed policy expectations are going to be, how the bond markets reflect that, how the currency markets reflect that, how gold reflects that. We've never seen, that I can remember, these kind of abrupt changes from one narrative to totally different one in 48 hours. That's not happened before.
No, it hasn't. And, that leads to one last question I have before we move on from the Silicon Valley Bank is, too big to fail?
Well, I don't know. Again, if the Fed has its way, they don't want to have to jump at this and bail this out, especially if there's going to be bigger dominoes to fall later. They, at different times, Powell and John Williams at the New York Fed, who's the second most powerful guy at the Fed because he's the one that has a checkbook in his hands for the central bank, the two of them are always talking about systemic issues. They'll tolerate to a point, and I think especially now that Powell is on this inflation fighting quest, and sure as hell isn't going to come out tomorrow or Monday and say, oh, now we got a crisis, I'm done raising interest rates, forget everything I said. That's not going to happen, at least not yet over something like this. He wants to be able to have this thing sort itself out, have some investors take their lumps, have some moral hazard reintroduced into the markets, because that all is going to help him in his quest to fight inflation by reducing demand. And if all of a sudden, and I'll give you a quick example, if all of a sudden markets say, holy cow, we're back to these pre-intervention days, and if we make an investment decision, by God, we got to live with it. And if we've made a mistake, we're not going to get bailed out. Look at what has happened with this series of rate hikes. And we can still talk about a lot of markets that are out of whack compared to where they should be fundamentally. Look at junk corporate bonds. And until this week, very little damage done to corporate bond markets. The spreads between bond yields for corporate bonds, even junk bonds, compared to treasuries, have stayed fairly tight because, again, everybody got used to this, never-ending flood of liquidity, Mike. and that we're not going to see any major defaults because the Fed won't let it happen. Well, I'm anxious to see how, and in my newsletter for people that don't want to have to, fool with options and things like that, I've got a, plain vanilla unleveraged mutual fund. It's exchange traded fund. The symbol is SJB. That ProShares puts out, and it shorts a basket of corporate bonds, or really an index on junk corporate bonds. Doesn't move much, if over the next 3 or 4 years we have an average recession and we see bond spreads open up and default rates go to what they should be in a recession, you probably get 50 to 75% of your money on this in the best case scenario. If you're out there and you want to be more aggressive, look at what the option chain is for put options on, JNK and things like that, the bigger corporate bond ETFs. But that's one of the things I'm going to be watching in the days ahead as this all unfolds. Are we going to see a recognition come back into markets that even though the Fed was the cause of this problem too, that's unfolding today, by creating this false Alice in Wonderland kind of world for everybody, and then all of a sudden pulling it away from it, folks, are they going to stick with that? Are they going to let people take their lumps? Are they going to let investors take their lumps? And as I started to say a minute ago, they'll do that as long as they can get away with it, and as long as the system itself doesn't seize up. Their nightmare that will cause them to respond is when all of a sudden in bond markets and otherwise, you have no bids for things, where bids for XYZ company's corporate paper dries up, and there's not a bid at any price. And then it reverberates to smaller banks that might have outsized exposure to certain things, where all of a sudden the share prices collapse there. Those are the extremes that happened back in the 87 stock market crash, in the 2008 stock market crash. Never really did in 2000 to 2002, because that was more of a drawn out affair. But for things that come about suddenly, you can have time. And I vividly remember, because most of my clients were IBMers, when the stock market dropped in 1987, out of nowhere, you couldn't get a bid on IBM. If and when the Fed sees that kind of thing, that the system is seizing up, then they'll be forced to respond. But I think they're going to wait if they can get away with it.
Well, and as if we hadn't already had enough to talk about, here comes the jobs numbers today.
Right.
So we saw a little higher than expected jobs numbers enter into the market. Again, going back to our discussion, I've always been the belief, until the jobs numbers start to diminish, that wasn't going to be a cause, elephant in the room accepted here, but until those job numbers started to slow, I didn't see the Fed slowing their process.
Well, no, and Jerome Powell said as much the other day, and again, a couple of the more entertaining Q&A segments where once you had Senator Pocahontas Warren from Massachusetts grill him from one political perspective, and then John Kennedy, the Democrat from Louisiana, grilled him from a different perspective, but both coming to the same conclusion and trying to get Powell to admit that, look, the end result of what you're telling us is that we're going to lose a few million jobs. What are you going to say to the people that are going to be out of work? Suck it up, Buttercup, because it's your patriotic duty to lose your job to help me get inflation back in a bottle, kind of thing. So he's not made any secret of the fact that, even though he admits that what he's using is a blunt instrument, another old saying is that when all you have is a hammer, everything looks like a nail. But that's where the Fed is at. And, it's a completely separate discussion, which you and I should have one of these days for our listeners, as to how you change this systemically. Because for as long as Jerome Powell and his ilk run the central banking system that we have on a fractional reserve basis, you're not going to solve any of these problems. And he's going to continue to think that the only solution is that you've got to cause a recession to bring down inflation. There's so many other things that can and should be done to avoid that, but he's not going to do them because it's not the Fed's makeup. which is why you've had people like Ron Paul run around for years, tell us why we shouldn't have a Federal Reserve in the first place. But again, that's a story for another day. So, Powell does want to see that. Interestingly, before the shutdown or looming shutdown of Silicon Valley Bank took all of the oxygen out of the room, there was a brief moment after the jobs number this morning where it looked to Wall Street more good than bad. Number one, the headline inflation rate unemployment rate, actually ticked up 0.2%, although you've got to put a big asterisk next to that. That was because of a big influx of people back into the workforce. The bigger thing that cheered up some folks was that the wage inflation number was less than had been expected. It was only up 0.2% when the expectations were it would be up perhaps even by double that. There's reasons why that might be an aberration. We'll know in coming months. But you made a good point to me a minute ago, which you should add here, as to how this is a lagging indicator anyway, and the jobs market probably isn't as good as it still appears to be, the risk being that all else being equal, and before the SVB thing got thrown into this whole mix today, that Powell probably would risk overdoing it, because by the time the jobs numbers get to where he wants them, it'll really be bad.
The unemployment numbers are actually, they went up considering that the new jobs numbers went up as well. And most people they look at that as a disconnect, but what they're not realizing is the unemployment numbers are actually a lagging indicator. So hypothetically, say you got laid off today and you got a severance package that's going to pay you 6 months worth of wages. You don't show up in those unemployment numbers until you apply for unemployment, which you cannot do until your severance package runs out. So you are effectively unemployed, but you're not included in those numbers. And as you and I, from watching what had happened, there was a number of businesses that shut down in the fourth quarter last year, and some in the early part of January, February this year. And a lot of those employees were receiving severance packages as part of their exit as these layoffs occurred. And those numbers aren't going to be reflected into those unemployment numbers. And depending on the nature of the severance package, that could be anywhere from a 3, 6, 8 month lag in between, depending on who got laid off and how big the packages were. So I think we're going to start to see these unemployment numbers really creep up over the next several months as those numbers start to float into the system. And even the jobs that are created aren't going to be enough to offset this.
No, I tend to agree, and we're in, and this becomes cliche to say this, Mike, but we're in very much uncharted territory. We have a lot of factors today that first gave us this unprecedented boom and everything bubbles, and now is probably going to be a rolling and hopefully, from the Fed's perspective, controlled comeuppance and rolling a few busts here and there in the years ahead. I mean, this is different than in past recessions. It doesn't come about the same. The traditional business cycle has long since been done away with by the Fed. We have credit and liquidity cycles that drive the economy, not business, regrettably. So we'll see what happens. I mean, will the numbers be as bad as they were briefly when we had, I think the unemployment rate at the beginning of the pandemic was even up to 13, 14% for a brief time before everything settled and some people were going back to work. So, if you remove that historical aberration, it's not been that many times that we've had double-digit employment. And I think what I hear you saying, and I agree, because you've got a lot of different factors in, we're only going to have to get back to an unemployment rate as the government measures it of 5%, maybe to as high as 6%, to reflect as bad an economy as we had in years past when unemployment was 10% or more.
Yeah, no, I'm in full agreement on that. So, Interesting times, Chris. And if people want to follow how you're going to negotiate yourself through these interesting times, how do they get a hold of you?
Well, besides listening to me on occasion on your podcast and others that I'm on and my own stuff, just go to nationalinvestor.com. And I can't stress it enough. If you're not already on at least my free newsletter list, make sure you click the button right at the top of the page and get on there, because you would have known, although I didn't know how it was going to unfold, at least the second part of it. I talked about both of these potential swings Monday night ahead of Powell's testimony. So, and now, of course, once again, we're in uncharted territory. This is the biggest financial institution failure since 2008 now. And whether it ends here, we don't know. Odds are it will not. But there's a lot of moving parts. And of course, as they move, especially in ways that cause me to change my recommended asset mix for our newsletter audience, of course, I'll be telling people about that as we go along. But it's to say it's interesting times is an understatement.
Yeah, I believe you and I are going to be having these chats for people to listen to a little bit more frequently in the coming weeks.
Absolutely.
Thanks for joining me today, and we'll be talking again soon.
Take care.
The Prospector News Podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.